Well, good morning, everyone. I'm Bob DiMeo. I am chairman of Fiducian Advisors and just absolutely thrilled to be able to host and sort of MC this program today. I'm joined by some of my colleagues and just really pleased with the overwhelming turnout we've had today. We've got a tremendous number of cultural institution leaders joining us today. And we're excited because this program here and really this entire initiative was really launched to provide leaders of cultural institutions with great framework for making sound financial decisions. Just to set the stage, I want to highlight the significance, and we hope to today highlight the significance of the survey and its relevance to these institutions. It underscores the importance of not only financial management, but also endowment or investment management and the governance that goes along with that. By way of the numbers, we had 226 respondents to the survey, and it's from a variety of institutions. So you have museums, botanical gardens, orchestras, and so on. And from a size standpoint, the pools of assets that folks are overseeing range from less than $10 million to a number of institutions with well over $100 million. Hopefully everyone can see my screen okay here. And I'm joined today by two of my partners, Devon Francis and John Fellows. I also want to give a really big thank you to all of the folks who participated in making the survey and this webinar possible. So we had Karis Coons with the American Association of Museums, who served on the working committee, as well as Karen Year from the League of American Orchestras, James Fawley from Morton Arboretum, Jim Jensen, another partner at Fiducian, and candidly, the list just goes on, where we've had so many folks work tremendously hard at putting this together. And so we're really proud of what we've been able to bring for cultural institutions and their leaders. I do want to at this point, and I can stop sharing for a moment here. I do want to at this point just simply mention a bit about our experts and the two folks who will have participating today. We have both of them are partners in the firm, and both of them really do a tremendous amount of work with nonprofit entities. You've got Devon Francis, who is an active member of the firm's Endowment and Foundation Council. She serves on our Mission Aligned committee. She's a prolific writer, and she also joins me in working and co-hosting the Nonprofit Investment Stewards podcast. And then you have John Fellows, who serves on the firm's discretionary committee, the firm's investment committee, the capital markets team, and he also serves on the Endowment and Foundation Business Council. So very pleased to have both of them join us. And before I jump to really digging in on the specifics of the findings and such, I do want to just provide, bear with me one moment. I want to provide just brief background for folks who are unfamiliar with Fiducian Advisors. The firm is nearly 30 years old and serving a number of clients across the country. I think we have clients now in 48 states, but 200 plus associates, 280 billion in assets under advisement in 7 locations around the US. Our expertise in serving nonprofits, we work with quite a few and basically try to help them do 3 things: be good stewards, improve performance, and reduce expenses. In terms of resources for nonprofit leaders, we're going to encourage folks to just hit our website, and not only the the podcast that I mentioned that Devon and I host, but there are all sorts of materials, white papers and position papers and such that I think leaders at cultural institutions will find useful. So with that, we do want to jump to the survey results, and we want to provide insights not only on what we learned, but we also at a point want to take you and advance the thought in terms of what then happened after the survey was completed in 2023, what happened, and what is the outlook for 2024. I will tell you that it was sort of reverse inquiry that this all came about, where actually the good folks at Morton Arboretum came to myself and Jim Jensen, folks here at Fiducian Advisors, and basically said, you know, it's tough to benchmark investment performance and governance practices and the like for cultural institutions. Many of you are familiar with the NACUBO study, which is basically intended for higher ed, but that's really a different makeup and a different moxie and oftentimes different objectives and so on than cultural institutions. And that's why this particular survey and report for cultural institutions was launched. So we're really pleased to have Devon and John to really delve into the specifics on the survey and to share their insights. And maybe what we can do is really have John just maybe share with the group really your thoughts on this inaugural launch and your high level take on the survey and if there were any surprises.
Yeah, so thanks, Bob. Thanks for having me on this, first and foremost, alongside the two experts on these podcasts, the webcasts. I think this is just a wonderful, endeavor by the firm with all the great partners that you mentioned, Bob. And you're right. I think the more specific we can get, as investment advisors to help, as you pointed out at the beginning, be good stewards for our clients, the better, right? The more unique we can get with our clients in terms of the very specific risks out there, the very specific kind of challenges out there, I think the better. So I think this survey does a wonderful job of focusing very exclusively on, the issues with cultural institutions. As I shared with you two, before, I went into this kind of with a little bit of a bias that in my anecdotal experience working with nonprofits all over, endowments, foundations, not just in the cultural institutions, my bias was going in was to think that perhaps there might be a structural underweight to equities from an allocation perspective. So I was actually a bit pleasantly surprised when I looked at the results that it was just the opposite. That by and large, it appears that the vast majority of the respondents are invested in an allocation very appropriate or very appropriate for endowments, long-term in perpetuity types of funds. So that was the first thing that jumped out at me really overall.
That's great. And Devon, perhaps the same to you, high level take on the report and the results and such.
Yeah, I wouldn't say that I was particularly surprised about any of the findings in the study, but what I was surprised at was the number of institutions that responded. So for the inaugural year of the study to have 226 responding institutions, I think that's just reflective of the fact that cultural institutions really have been kind of desperate for this benchmarking. And it was really great to see that not only did we have 226 institutions respond broadly, but it was a wide array of institutions from the small size to, as you mentioned, over 100 million. We got really great sample sizes in all of the various cohorts. We had different types of institutions responding. So I think that helped the results be very statistically meaningful, which was, kind of a surprise, but a wonderful surprise.
Yeah, that's terrific. And so for folks who have not seen hopefully this is appearing here. No, that's not what I wanted to share. Let's, for folks who have not obtained the survey yet, it really is a wonderful representation of your peers and so on. And from a topic standpoint includes, of course, a lot about the financial markets and such, which have evolved since then, but allocation, performance, setting objectives, governance, and so on. So we would encourage folks, if you haven't obtained the survey, to request the survey. Thanks again to all those who participated in the survey and provided input. But maybe what would be best here is, Devon, perhaps we can, I know investment committees and financial officers and such are always interested in, hey, how are my peers invested relative to me? Maybe you can speak to that.
Sure. And if you wouldn't mind flashing up on the screen what the results are, Bob, I think that might be helpful. So as John mentioned in his opening remarks, we were pleasantly maybe not surprised, but we were pleased to see that most institutions do have a very diversified portfolio. It's no surprise that when we look at the largest cohort of respondents, those over $100 million in their endowment, that you have a much higher allocation to private investments, to hedge funds, those sorts of more sophisticated investment strategies. In terms of the equity exposure, when we look at the domestic versus international breakdown, also no surprise that we see with the smaller institutions a more pronounced home country bias. But certainly it is nice to see that all respondents had at least some exposure to international equities. So I think that's helpful. One thing that did kind of strike me is that the smallest cohort, those under $5 million, had a lot of cash sitting on the sidelines, more than 11% cash. So when you're talking about a perpetual time horizon and an asset pool that is expected to exist into perpetuity, we generally like to see all of those assets be put to work in the markets and let the markets grow over time, which will help you achieve that intergenerational equity. One of the things, just kind of anecdotally, I've been working with onboarding a new museum client. And it's a pretty sizable portfolio. And up until this point, they have not had any exposure to international equities. And the committee was very resistant. We recommended a pretty sizable allocation, and the committee really wasn't comfortable at all having that type of exposure. And, we did some back and forth, and the committee agreed to dip a toe into the international waters. So we did start off with a very modest allocation. But when we sent this survey out, the CEO of that institution actually reached out and said, "Oh, I was really, surprised to see the exposure to international equities among our peers. And, this, perhaps I think benchmarking like this can give a measure of comfort that, what may seem like perhaps a scary asset class or something like that, well, your peers are actually, have a sizable amount of exposure to those areas of the market." So I think that's, one way in which this study is very meaningful.
That's great. And John, similar amongst the clients you're working with, or any takes or differences there?
Yeah, so I completely agree with Devon. The one thing, Devon, is is that in a year like 2022, which is an extraordinarily unique year by any measure, that cash actually helped, right? So kudos to those smaller institutions in a 1-year window at least, but longer term, Devon, you're exactly right. So just from a trending standpoint as well, kind of, Bob, looking back over how amazing a 3-year window, it's been even longer than that, actually. Just the trends kind of shifting more towards unwinding perhaps some of the equity tilt that we had when interest rates got incredibly low. So kind of shifting more towards perhaps a little bit more towards fixed income. And then the thing that jumps out to me as well, and I'm seeing a lot more interest in, is more on the private market side. So you see a very growing, private debt world, private credit part of the market. So that's getting a lot of traction. You see that, I think, popping up a little bit more in the smaller types of endowments and foundations. So kind of setting the stage. I don't want to put the cart before the horse, but kind of searching for those returns and ways to kind of diversify even further from where they're at into strong returning asset classes. But I think Devon nailed it. The most important part for all of these institutions is really to have a well-diversified portfolio across all these different asset classes. And more importantly than that, even, is to be very conscious of the strategic asset allocation decisions and how those ultimately will be the number one driver of returns, and of course, risk around those returns.
So that nicely sets the stage. And if there's one thing I think cultural institution leaders want to know even more than how am I allocated relative to my peers, it's how am I performing relative to my peers. So maybe we can jump to that, Devon.
Sure. So if we look at the investment results, this study was conducted based on data from the end of 2022, which I'm sure we'd all love to forget 2022. It was a really terrible year across the investment universe. So we do see very weak results on a 1-year basis. So the institutions that were less than 9 million had a calendar year return for 2022 of negative 13.4%. But then you see positive results on an annualized 3, 5, and 10-year basis. Then you see the middle cohort between 10 and 50 million. And then we also have results for institutions over 50 million. it's no surprise that when we look at the 2022 results, the largest endowment or foundation pools were the best performers. Now, it's all relative because down 11.45 is not a great result in absolute terms, but compared to the two smaller peer groups, the larger endowments certainly held up a little bit better. And that's largely a result of the asset allocation that I highlighted on the prior slide, where those institutions tend to have more exposure to hedge funds, which help provide downside protection, and also more exposure to private investments that weren't as impacted in the mark-to-market of 2022 that we saw. When you look on a 10-year basis, results are about the same between all of these differently sized endowments. So we're looking at annualized results on a 10-year basis between 6.25 and 6.5%. I want you to put a pin in that because we're going to think about that when we start talking about some of the spending practices. I think that'll be important.
That's great. And so again, Devon, you pointed out just how tough 2022 was. And John, you pointed out early about, boy, it was good to see the equity exposure that many cultural institutions had, at least in 2022. Did you see any changes, John, in the way investment committees were allocating in 23?
Surprisingly not, Bob. And as I think most folks probably are aware by now, what made 2022 so unique was the fact that you had the global equity markets were negative alongside bond markets being negative, right? So bonds didn't hold up their end of the bargain as they typically would in a normal kind of bear market, and that clearly was because interest rates had gotten so incredibly low. But my anecdotal observations were investment committees generally were very measured about it, right? And I think part of that was a result of how remarkably well markets had done the 3 years prior to that. So you could make the case that especially equity markets got a little bit over their skis, right? And keep in mind that was through the pandemic. So, if you look at a global equity index, 2019 up 27%, 2020 in the midst of the pandemic up 17%, and 2021 up 19%. So you had really, really good performance in the 3 years leading up to 2022. So I think there was a general, and we were of course educating our clients to that end that, hey, this is not going to last forever, right? And there was that sense that we're probably due for a little bit of a pullback. Investment committees were very measured and kind of understood what we were getting into. And as a result, you didn't see any robust, material changes. Allocations were actually in pretty good shape. It was just more about rebalancing and kind of taking advantage of subtle opportunities that the markets presented us.
Yeah, thank you, John. And we're getting questions in the chat. Please continue to add those, and we'll definitely plan on Q&A towards the end. But the couple of questions of what's the name of the survey and or the report, and how do we obtain it? We'll make sure everybody participating on this call receives a link so that they can obtain that. And then someone asked about what is the other in terms of asset allocation. And that can be a lot of different things. In this instance, it could mean something like commodity exposure, which I don't think we specifically identified. But it could, I've worked with nonprofit clients that, maybe received a grove of oak trees in an inheritance, if you will, and they ended up having that as part of their allocation. So the other can really cover a broad range. Devon, maybe we can shift to on the investment front. We asked, and we call it here at Fiducient, mission-aligned investment, covering things like socially responsible investing and DEI and so on. But can you speak to those responses and practices as well?
Sure. So we captured a lot of data in the survey. I wouldn't say that there was an overwhelming trend or a theme regarding either ESG investing or socially conscious investing or a focus on DE&I. We tend to see things ebb and flow. A lot of institutions, I think if I hearken back to the results, 53% of institutions indicated that being socially conscious in some way was of either reasonable or high importance. But then there were also a lot of respondents that said it was the least important thing. They're, not thinking about it at all. We tend to see more of a focus on things like ESG, DE&I, SRI, that sort of thing, a lot of acronyms, when we are in a strong market environment. So given the fact that we were conducting this study on the heels of 2022, which was a very weak market, environment, I think in some cases folks focus may have shifted to all I care about is investment returns. I'm not going to prioritize incorporating ESG investing. ESG stands for environmental, social, and governance. But certainly it was a mixed bag. One thing that I will say is that the larger the endowment pool, the more focus on diversity, equity, and inclusion. So, we tend to see these things trickle down. So you tend to see focus amongst the largest institutions, and then over time that will flow through to smaller institutions as well. In our client base, anecdotally, we certainly have seen a lot of questions being raised. We've seen a lot of interest. We conduct what we call, a DE&I and ESG summary analysis, where we can go through each of our clients' underlying investment strategies and perform, a high-level analysis. Is this manager incorporating ESG criteria into their investment process? What is the employee makeup? What's the makeup of the investment team? So on and so forth. A lot of clients are requesting that type of work, but not necessarily making changes to their investment approach as a result of the findings. It's just they're kind of trying to, figure out where the line in the sand is, and then over time may consider adopting more of a focus on DE&I or ESG. But certainly was a mixed bag in terms of the results that we saw from the study.
That's helpful. And I know we'll jump to spending and governance in just a moment. So we'll try to keep this tight. But are either one of you seeing a difference between sort of client questions and interest and action?
I would say more, sorry, John,
No,
more
please, go for
along
it.
the lines of the questions and less in terms of action.
Mhm.
Just kind of getting the lay of the land, not necessarily taking any definitive measures or, change in approach. John, I don't know if your
Yep.
experience
Yeah,
has been different.
as usual, Devon, you took the words right out of my mouth. So I would say most clients are interested in ESG, SRI, DEI, MAI. Did I get all of them, Devon? Interested, and they ask good, healthy questions like how does it work? What does it do? Does it impact performance? And a lot of times it opens up a wonderful dialogue, internally with investment committees. Some say, yes, let's explore it. Some say, you know what, it's probably not the right fit for us at this time. So I've really noticed a very pragmatic approach to it, which we think is, of course, the right way to do it.
That's great. And I think it's circumstance or environment dependent that you mentioned, Devon. I remember a client of mine, they've got a wonderful chair, really savvy investment professional as chair of this nonprofit. And she just said, are we asking this dollar to do too much between, environment and DEI and returns? And so it probably depends on the environment. So let's jump to spending. And Devon, there are a couple categories that we really queried with respect to spending and budgeting and things of that nature. Do you want to cover that and share the results?
Sure. So, we asked questions about the effective operating spending rate and then the effective total spending rate. So I think it's probably a little bit more helpful for us to go through the results based on the effective total spending rate. And what that total spending rate encompasses is not only operating expenses, that's the lion's share of it, but also capital expenditures, any sort of special projects, debt service, basically all spending that is coming out of the endowment. The way that the effective total spending rate is calculated is the dollars spent divided by the total endowment value. So the effective total spending rate is not necessarily the equivalent of the stated spending policy. So I think that's important to differentiate between the two. So you can see there was a wide range of responses. We did have a couple outliers that are skewing that $25 to $50 million cohort, but the overall average effective total spending rate for cultural institutions was about 6.5%. And I asked you when we looked at the performance results to put a pin in the 10-year annualized return, which fell between 6.25% and 6.5%. So those annualized returns are nominal returns. When we think about spending and creating intergenerational equity, we need to factor in inflation. So a practice of spending about 6.5% of the endowment value over time is pretty hard to sustain. And what you're going to do over time, if you're not able to generate a return that exceeds that spending rate plus inflation, you're going to chip away at the purchasing power of the endowment pool over time. Now, that being said, we know, it's easy for us in the investment consulting chair to say, you have to spend less, but we know that cultural institutions are facing a lot of hardships, and they need to keep their doors open, and they need to, keep animals fed or keep acquiring new artwork or whatever the case may be. So we're certainly cognizant and sensitive to that fact that, spending, you need these dollars to be working for the institution, or else the institution might not exist. But it is, you might have an institution that has a stated spending policy of 4.5%, but then in practice, when you go to calculate the total effective spending rate, it's closer to that 6.5% average that you see.
Anything to add there, John?
I would only add that I think given the, most spending policies are, if you look at, like you mentioned earlier, Bob, the Nakubo study, something like that, a 4 to 4.5%. I think maybe Devon, correct me if I'm wrong, but those effective spends in cases where you have a 3 or a 5-year trailing, moving average might be a little bit elevated given the great years in 19, 20, and 21. So that might be cooked into those numbers a little bit on top of the things that you also mentioned. So just the nature of how markets have behaved and those, average spending policies probably impacted a little bit as well.
That's great. Well, let's jump to governance and decision making. And Devon, what commonalities did you see among the responses?
Yeah, I would say the biggest commonality is that most institutions, at least ones that responded to this survey, are using an outside professional to advise on their investment pool. So it may be a discretionary OCIO advisor. It may be an advisory, someone that's giving advice, but doesn't necessarily take discretion. But for the most part, nearly all of the responding institutions are using an outside professional to help them oversee these asset pools.
That's great. Why don't we jump to go forward priorities? That was an important question in the survey. And it's funny, I see something in the chat where basically we have a participant calling out that, hey, these 10-year return numbers, they're not very impressive. And that's right. He's absolutely right. And it doesn't support the spending that Devon's speaking to, but it's very endpoint sensitive. If you had snapped that 10-year picture the year before or a year later, it really changes that 10-year average annualized return quite a bit. But let's go to the go forward priorities, Devon, and take it from there.
Overwhelmingly, institutions reported that improving investment returns was their top priority. You can see in every size cohort that was the majority of respondents indicated that was their top priority, and then all of those other priorities fell far by the wayside. One of the things that was a little disappointing to me is that improved governance was not a priority for many institutions. And it's been our experience that when you improve governance practices, you actually have the potential to be able to improve returns because you create a more disciplined process. You always keep your eye on that big picture perspective, which I think can be helpful. It can help committees avoid kind of a knee-jerk reaction to a specific market environment. John talked a little bit about the discipline that our clients at least exhibited even after a very difficult 2023, didn't head for the hills, didn't change their asset allocation because they understand the importance of a long-term strategic approach. I think that we would like to see improved governance be a bit more of a priority for some institutions. But we understand that the investment returns are at the forefront of folks' minds.
Yeah, super helpful. So why don't we, as we mentioned, this survey was through 2022. And we actually originally tried it through 2019, and then something hit cultural institutions and many others, in early 2020, right after we sent out the survey. So we plan on doing this again at the end of this year, and hopefully it'll be an every other year sort of exercise. But what we wanted to do, because 2022 was so dismal, was bring you up to speed on what happened in 2023, as well as share what we're expecting going forward, and then we'll jump to questions. So John, can you give a recap of what we saw in 2023?
I would be happy to, Bob. And I guess I would just start by saying it was by almost any measure a remarkable year, right? So when you think of these individual bars, and I certainly won't touch on all of them, those are the calendar year returns for 2023. And by any measure, if you exclude commodities, which, as we touched on before, isn't kind of a dedicated asset class for us at this point, by any measure, these are terrific returns, for any year, especially when you look at something like equities. What made this year, in my humble opinion, so unique is how back-ended a large majority or a large portion of these returns came. And by that, I mean literally in the months of November and December. So just cherry picking quickly, if you look at that US core bond index, the third bar from the left, it shows a Bloomberg aggregate bond index, nice, safe US investment grade bonds returned 5.5% for the year. You say, wow, that was a pretty good year for bonds, right? What is remarkable about that is all of that return and then some came in the fourth quarter alone. So in other words, even if you extend it all the way through the end of October, that index was negative, right? So the bonds were actually posting a negative return at the end of the month of October, and then November and December had extraordinary returns, up 4.5%. In November and 3.8% in December alone, to pull that index back into positive territory, and obviously healthy positive territory. So an extraordinary turnaround, right? If you look at equities, like just looking at large cap US equities, a 26% return for the year in the S&P 500. And to be fair, the S&P 500 was positive most of the year, strongly positive for most of the year. But if you look at what happened in the fourth quarter alone, that's a 12% return in October, November, and December. And again, that index was even negative in October as well. So that number is even higher when you look at just November and December. So you kind of look across those gray bars in the middle. Those are the global equity markets, traditional global equity markets, if you will. Incredible returns, right, at the end of the year, again, November and December, in a world that didn't feel like a great time to be an equity investor, right? So, Devon mentioned governance. I think part of governance is, I hope I'm not getting ahead of us here, Bob, but investment policy, discipline, strategic asset allocation. You've heard me say a few times. Just one quick story, and I'll hand it back, Bob. I had one foundation client, cultural institution client, on October 26th say, hey, John, our finance committee met and we'd like to consider selling 50 to 100% of our equities. October 26th. So think of that day. Had they moved forward and done that, they would have missed out on those returns in November and December. So governance, discipline, having a dialogue about scary things that are always going to be happening in the world was probably more important in those 2 months than I've seen in a long, long time. So, extraordinary year overall in the markets, but you really had to stay the course through the year to really see those returns that we just looked at.
Yeah, super helpful, John. So that was 2023, a remarkable year coming off of 2022, a remarkable year in a different manner, right? And then, so what are we thinking about on a go forward basis? And we'll be brief with this because we do want to have time for Q&A. But basically, our theme coming into this year is prepare, don't predict, right? And going into 2023, it was almost universal opinion by economists that we would see a recession in 2023. And it never came, right? It will come at some point, but it never came. And markets performed much better than folks anticipated. Coming into this year, I won't say it's as one-sided as it was last year, but there is a strong bias towards we're going to pull off the soft landing and things will be just fine. And we may or may not. So here are our three themes this year. Number one is it'll be a messy middle regarding inflation. Don't expect, inflation, we see how that has driven markets one way or the other. And don't expect a straight line down to 2%, the Fed's target of 2%. Expect there to be some back and forth on that. And sort of the punchline is make sure your portfolio has different allocations that give you a fighting chance of performing okay in different environments. Number two is the prepare, not predict. We will see recessions. We will see market declines and things of that nature, again, underscoring the importance of diversification. And then concentrated consequences. The Magnificent Seven, as it's referred to, have driven this market in a tremendous way in the US. And it's very hard to know when that sort of unwinds, and it can go on for quite some time, but it typically doesn't end all that well. So just a couple of things to keep in mind here we're asking leaders to think about is, yes, markets drop 5% regularly, about 3 times a year, and they drop 15% about every 3 years. And we enter official bear market territory, which would be a decline of 20% or more, about every 6 years, and that lasts about a year. And yes, we still see recessions, and those come on average about every 6.5 years. So how are we thinking, to Devon's earlier point, about most of you are leaders at in perpetuity institutions? And if you are, how are you going to construct a portfolio that gives you a fighting chance of sustaining what you need to do with respect to your financial management and such? And the last, well, this is a paper everyone should request. This is super busy, but the long story short here, these are our 10-year forward-looking capital market assumptions. We're expecting more out of bonds or fixed income. That should trigger a discussion with your investment committees. What are we doing on the fixed income front? And is it active or is it passive? We're expecting a little less, largely because we came off such a great year over the next 10 years in terms of equities. And then we're expecting generally a bit more out of alternatives and real assets, things like private equity and hedge funds and such. I'll close with this, which is a super busy chart. Some will refer to it as the quilt chart, but just take since the beginning of the pandemic, 2020, and what you have represented here are most asset classes. And if you look at 2020, the leader was US small cap stocks, and bringing up the rear were US REITs, or real estate investment trusts. Well, in 2021, REITs were at the top. In 2022, commodities were at the top. And in 2023, large cap US. So the message is the leaders take turns at the top. And if you look at the sort of gold or bright yellow, that is a balanced, broadly diversified portfolio. And we're real advocates for an in perpetuity type time frame, to not bet the farm on what is the economy or market doing next year, but to have broad, thoughtfully diversified portfolios. With that, I'll just ask if Devon or John have anything else they want to underscore before we jump to questions.
Not right now.
Okay, good. So Devon, this one might be for you. This is regarding spending. It's a question on, we take 5% of the average value of the last 12 quarters. Our endowment value is about to double due to a new gift. How do organizations address significant new gifts, contributions, if you will, calculating the annual distribution?
Great question. First of all, congratulations. That's wonderful. And not often do you receive, it can be hard to get donors to contribute to the endowment. It's not super exciting. It's not like giving money for a new building. So congratulations, that's a feather in your cap. I think you need to think about the donor's intentions. There's no cut and dried rule as to how you are required to handle this. But generally speaking, the donor probably wants her assets to be, or her dollars to be used, sooner rather than later. So what I have seen some of my clients do is take, let's say, you're getting your portfolio value is currently 20 million and you're getting a $20 million gift, to kind of backdate that $20 million gift and bring that into the 12-quarter moving average calculation over the last 12 quarters. And then that way, let's say your spending policy is 5%. The donors, 5% of the donor's gift is being put to work right away. Other institutions don't want to handle it that way, but just know that if you do wait until that final quarter, so only 1/4 of the 12-quarter moving average is, has that much higher endowment value, those dollars aren't going to be put to work for 3 years. So it's certainly something to think about, but we do often see folks kind of capturing a large gift on a backdated way.
Yeah.
Thank you, Devon.
If I could just piggyback on that, Bob, there is no right or wrong way to do it. And I think you nailed it again, Devon, that the number one thing from our perspective is to honor the donor's wishes, right? To the extent that the donor says, do whatever you want to do. Oftentimes the question comes up with regards to underwater endowments. So the fear being that, hey, you start the spending policy on this big gift, the markets fall apart. Now you're underwater on that endowment. How do you work with that going forward? And I think as a practical matter, it's good to know that the Uniform Prudent Management of Institutional Funds Act, or UPMIF, allows for that, right? So you have the flexibility to do that. But I think it's important organizationally, again, going back to governance, to make sure you have a policy to say, here's how we do it. So one client that I work with says, you know what, we're not going to apply the spend to any new gifts until they're allowed to kind of cook or invest for 1 year, and then they'll start that. So it's kind of like giving a year, before they actually implement new gifts into that spending policy. So there's no right or wrong answer, but I think there's a lot of different solutions that internally from a governance standpoint really makes sense to discuss ahead of time.
Yeah, that's great. So we've got a few questions in a few minutes, and I think we can get through this here. Someone asked about, this was a pre-question, the percentage of operating funds supported by the endowments is surprisingly low. Do you have any data on other sources of revenue? We don't. We worked with the working committee on really narrowing the number of requests and questions. But we're asking folks, because we'll be doing this again in the not too distant future. If you'd like to see that, definitely suggest that. And if we hear more than a couple, we'll include it. Another question, and then we'll get to John, you on stock picking versus index funds. There's an active passive question, but someone asks about AI and could it provide accessible tools that help facilitate responsible stewardship? The short answer there is yes. I mean, AI, first of all of you are invested more in AI than because if you own the S&P 500, you actually have some nice links and exposure to AI. But also when you think of the algorithms that are being developed on everything, and there are a lot of financial institutions that are using AI on governance type of practices and such. So our punchline, and this is a good reason you should go subscribe to the Nonprofit Investment Steward podcast. Devon, our next podcast is going to be on AI and its implication in portfolios and so on. But sort of the punchline is AI is probably overhyped in the short term, and it's probably underhyped on what the impact will be over the next 10 plus years. So, John, there was a question on stock picking versus index. We call it active versus passive here. Do you want to share high-level thoughts on that?
Yeah, and if I could brag for a moment about our research team, we've been doing a wonderful white paper on what we call the active versus passive research debate. So, where does it make sense to, as the question posed, kind of stock pick versus just say, let's drive down cost and be passive. And our research has been pretty consistent going back to 2007 when we first started doing it, that we just think areas like US stocks, large and mid-cap US stocks, tend to be incredibly efficient. And by efficient, we simply mean it's very hard for a stock picker, an active manager, to add value after the additional costs that they undertake to do so. So we, generally speaking, recommend passive indexing approaches in large cap and mid cap US equities. The flip side of that in 2023 was an extraordinary example of it. In fixed income, we see active management as adding multiples of value over and above the extra cost that you receive, and that's a result of the very dynamic markets that we've seen in fixed income. And then maybe even more extraordinary than that, when you look overseas, internationally, in a year like this, particularly emerging markets. I didn't touch on it, but one of the bars that we saw was emerging market equities was up just shy of 10%, well below kind of the developed markets, US and international. But if you had good active managers in that space, remarkably, those active managers in emerging markets in a year like 2023 were actually able to keep pace almost with what happened in US markets. So long-winded way of saying that in areas like that, overseas markets, we think there's extraordinary value of not trying to stay passive and reduce costs, but to have a really good investor, a good active manager that can add value, can underweight China, for example, in a year like 2023 to add that incredible value. So the answer is, it's not an all or one. It's let's be smart about what does the research tell us over time. It's never 100%, obviously, but it's been a really, really good guide, kind of having that research muscle to point us in the right directions across those different asset classes.
Thank you, John. And thank you, Devon. This has been absolutely terrific. We advertised a 45-minute program, and I think we're right at about that, maybe a minute over. Want to thank everyone who participated in the survey. Want to thank everyone who created and really worked hard in developing the report and so on. We encourage you to, and we'll make sure everyone who attends this receives this email address and so on, and links to obtain the survey if you don't have it. But share with us what you'd like to see on the next survey. We hope you found this useful. If we can help in any way, we do observations and consideration analysis, which is sometimes very helpful to someone overseeing a cultural institution portfolio. But AAM has been terrific, and others working on this. On behalf of John and Devon and everyone participating on this, thank you, and we wish you well.